Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be here.
So today is Thursday, January 22, 2026. And, if you were glancing at the financial tickers this morning, maybe while sipping your coffee, you might have seen a number coming out of Asia that looks, I don't know, like a typo, or maybe a glitch in the matrix.
Right.
The South Korean stock market, the KOSPI, has just shattered the 5,000-point ceiling for the very first time in its history.
It is a massive, massive milestone. I mean, for traders in Seoul, seeing a 5 at the front of that index is psychologically huge.
Like a sound barrier.
It is. It's like a runner finally breaking the 2-hour marathon or, the Dow Jones crossing 20,000 all those years ago. It just changes the whole paradigm of what's possible.
It really does feel like we're living in the future. But, okay, here's the thing that really caught my eye. And it's a bit of a head-scratcher.
Yeah.
We've got these record-breaking stock numbers in Korea, but at the same time, we're seeing this strange phenomenon all across Asia where local currencies are getting stronger against the dollar.
Which is normally a good thing.
Right. But foreign investors are actually leaving some of these stock markets.
Yeah, it sounds completely contradictory, doesn't it? Usually when a country's currency goes up, it acts like a magnet for foreign money. Investors love a rising currency.
Of course.
But right now, we're seeing the opposite. The currency is up, but the foreign money is packing its bags. It is a complex puzzle.
So that is our mission for this deep dive. We're going to try to unpack these two massive trends, the historic Korean rally and this, I don't know, weird game of musical chairs happening with Asian currency.
And we'll do it in plain English.
Exactly. No PhD in economics needed to follow along. We'll be relying on some recent market analysis, data from the Financial Times and Reuters, and some really critical reports from investment banks like JP Morgan to help us make sense of it all.
Yeah, we'll try to cut through the noise and get right to the signal.
All right, so let's dive into that big headline first. The KOSPI hitting 5,000. For our listeners who might just follow, the S&P 500 or the NASDAQ Q, can you put this in perspective for us? Why does this matter so much? Is it just a round number?
It's so much more than just a number. You have to understand, for over a decade, the Korean market was kind of trapped. It was in this sideways trend.
I think I remember hearing traders call it the box pie.
That's it, the box pie, because it was stuck in a box. It was, notorious for being cheap but never really growing. So breaking 5,000, it signals a real structural shift. It signals that the market has finally broken out of that box. And, it's really graduated to a new league.
So the box pie is officially dead. Long live the 5,000 KOSPI.
Mm-hmm.
What fueled this? Was it just excitement, or is there some real gas in the tank here?
Oh, there's real gas. There are two main engines driving this rocket. The first, and honestly, it's the most powerful one, is the AI explosion. But we have to be specific here.
Okay.
It's not just generic AI. It's about the hardware bottleneck.
The hardware bottleneck. You mean like chips?
Specifically high bandwidth memory or HBM. You just can't run these massive AI models, the ones we all use every day now in 2026, without incredible amounts of this specialized memory.
And South Korea is kind of ground zero for that.
It's the global headquarters for this specific type of memory.
Right. So we're talking about Samsung Electronics and SK Hynix. They are the heavy lifters.
Precisely. They're the ones selling the shovels and the pickaxes for this 21st century gold rush. And this isn't just speculation. Think back to the World Economic Forum in Davos that just wrapped up.
Right.
Jensen Huang, the CEO of NVIDIA, he made some serious waves with his comments there.
Oh, I saw that. He was talking about the future of infrastructure, wasn't he?
Yes, he explicitly stated that trillions of dollars are still needed for AI infrastructure. Trillions with a T.
Wow.
And that statement, for investors, was the green light they needed. It confirmed that this whole AI boom isn't some short-term fad like, 3D TVs or NFTs.
Right, it's not a flash in the pan.
It's a long-term construction project, a CapEx cycle, as we say in finance.
So when the guy running NVIDIA says we need to spend trillions more, the companies making the chips for him suddenly look very, very attractive.
Exactly. Investors suddenly realize this is a multi-year build-out. That pushed Samsung and SK Hynix stock right through the roof, and since they make up such a huge chunk of the Korean market, they basically drag the whole index up past 5,000 with them.
It's like if Apple and Microsoft both doubled in value overnight, The S&P 500 would just automatically skyrocket.
That's a perfect comparison.
Okay, so engine number one is the AI chip boom.
Yeah.
But you mentioned a second engine, something in the analysis about government policy.
Right. This is the other half of the story. It's about finally fixing the Korea discount.
The Korea discount. That sounds like a coupon you'd get at a duty-free shop.
I wish it were that simple. It's actually a term for a pretty frustrating reality. For a long, long time, Korean companies were undervalued compared to their global peers.
Like an Apple or a TSMC.
Exactly like them, because their corporate governance was, well, let's just say it was complicated.
Complicated?
You had these massive conglomerates, really confusing ownership structures, and they weren't always great at sharing profits with their shareholders. But recently, the South Korean government, under President Lee Jae-young, has been pushing really hard for these corporate value-up programs.
Value up. I do like the branding. It's simple, direct.
It is. And they're actually doing things. They're revising the Commercial Act to protect regular shareholders, not just the founding families. They're encouraging companies to buy back their own stock, to increase dividends.
So if we were to use a real estate analogy, it's kind of like a homeowner finally deciding to renovate the house, fixing the cracked foundation and painting the walls so they can finally justify a higher selling price.
That is the perfect analogy. The market is realizing that not only is the house full of this incredibly valuable AI technology, but the foundation is finally being fixed. That double whammy is what pushed the price to 5,000.
That makes a lot of sense. But here's the question everyone asks when they see an all-time high like this. Is it too expensive to buy now? I mean, did we miss the boat?
Surprisingly, the analysis seems to be saying no. Even at 5,000, the market doesn't look obviously overpriced.
How is that even possible?
It's because the earnings expectations are just so high. If you expect a company to double its profits because of this AI demand, then paying a higher price for the stock today still makes mathematical sense. The price tag is high, but the potential payout is even higher.
Okay, that sounds incredibly optimistic. But I have to play devil's advocate here. Nothing goes up in a straight line forever. What are the risks?
You're right to ask, and there is a glaring weakness in this rally. The data calls it narrow breadth.
Narrow breadth. That sounds like a medical condition.
Well, it's a market health condition. Imagine a basketball team that just won a game 100-90. But when you look at the scorecard, you see that just 2 players scored 95 of the points, and the rest of the team kind of just stood around.
That sounds like a really risky team. If one of those 2 stars twists an ankle, the whole team gets crushed.
That's exactly it. The KOSPI rally is heavily concentrated in those semiconductor giants and maybe a few auto companies. Both the Financial Times and Reuters point this out. If you take those few companies away, the rest of the market really isn't doing all that well.
So it's a very top-heavy rally.
Very. And there's another twist here involving the retail investors. In Korea, they have this nickname for them, the ants.
The ants. I love that. Hardworking, numerous.
Yes. But here's the irony. The ants largely missed this party.
What? Why? How?
Well, over the last year or so, a lot of Korean retail investors actually moved their money into U.S. stocks.
Oh, way.
Yeah, they thought the U.S. market was safer and had better growth. So while their own KOSPI was climbing to 5,000, a lot of that local money was actually parked in Tesla or Nvidia over here in America.
Ouch. So they're watching their home team win the championship while sitting in the opposing team's stadium. That has to hurt.
Yeah. And that creates a real risk now. We might see a wave of FOMO, fear of missing out. If the ants suddenly decide to rush back into the Korean market at these super high levels, it could create a lot of volatility. Yeah. Panic buying can be just as chaotic as panic selling.
That is a fascinating dynamic. And I think I saw something in the data about the actual economy versus the stock market, a sort of disconnect.
Yes, this is the economic disconnect. While the stock market is celebrating these future AI dreams, the actual South Korean economy shrank by 0.3% in the fourth quarter of 2025.
Wait, hold on. The economy actually shrank, but the stock market is at an all-time high.
It happens more often than you'd think. The stock market is a forward-looking machine. It's betting on future AI profits, not on the current economic reality. But it is a stark reminder that Main Street and Wall Street, or in this case, Euro, are living in 2 very different worlds right now.
Okay, let's pivot to the second part of our deep dive. We've talked about the KOSPI, and let's talk about the money itself. We're seeing Asian currencies, like the South Korean one, getting stronger against the US dollar. And usually, if a country is doing well and its currency is strong, you'd expect foreign investors to just pour money in. But the data shows they're pulling money out.
That is the paradox we are seeing right now. I mean, in November 2025 alone, something like $22 billion flowed out of Asian equities.
22
And
billion.
that's a 6-year high for outflows.
So the currency is getting stronger, but people are selling the stocks. Let's break this down. First, why are the currencies so strong to begin with?
It's really two main reasons. First, the US dollar has been getting weaker because pretty much everyone expects the US Federal Reserve to start cutting interest rates soon. When US rates go down, the dollar usually drops with them.
Okay, so the dollar itself is sliding. Makes sense.
And second, Asia just looks pretty stable fundamentally. Inflation is low compared to the West. According to a report from ING Think, Asia is seen as a kind of safe harbor for cash. So investors are happy to hold the currency.
Okay, so they like the currency, they like the house. Why are they selling the furniture, the stocks?
Profit taking. It's pure and simple, buy low, sell high.
Of course. The oldest rule in the book.
Think about it. We just spent 10 minutes talking about how Asian tech stocks exploded because of AI. Investors who bought in a year ago are sitting on massive, massive gains. They're looking at these record highs and saying, okay, thank you very much. I'm going to cash out now.
And here's where the currency part comes in, right? If the local currency is strong, when you sell your stocks, you actually get even more dollars back.
Precisely. It's an exit sweetener. If you sell your Korean stocks while the won is strong against the dollar, your profit check when you convert it back to dollars is actually bigger. So the strong currency is actually encouraging the selling.
That is a great insight. Just because you like the currency doesn't mean you want to buy the stocks if you think those stocks have already gotten too expensive.
That's it exactly. You can hold Korean won or Japanese yen in a bank account or a bond and enjoy that currency appreciation without taking the risk of holding these, volatile tech stocks.
That makes perfect sense. So $22 billion left the building. Where's that money going? It has to land somewhere.
It's rotating. This is what people are calling the great rotation of early 2026. A lot of it seems to be moving into European stocks.
Europe? Really? I wouldn't have guessed that.
Yes. Investors see European stocks as being cheaper than American or Asian tech stocks right now. They're value hunting. And also, a lot of money is moving into emerging market bonds. If you think the dollar's going to keep falling, holding bonds and other currencies is a great way to make money.
So it's like a giant game of musical chairs. And right now, the music has stopped on Asian tech and it started playing for European value.
That is a great way to put it.
Now, we can't talk about markets in 2026 without talking about the elephant in the room, the geopolitical landscape. We have President Trump back in the White House. How does that factor into all this volatility?
Oh, it's the Trump factor, and it is huge. Markets just hate uncertainty, and right now, headlines about tariffs and trade deals are a daily occurrence.
It feels like every time I open my phone, there's a new tariff threat or a tweet about a trade deal.
And the markets react instantly. It makes investors very, very jumpy. A threat of tariffs causes a dip. A sign of relief causes a rally. This just adds another layer of fragility to everything we just discussed.
And speaking of fragility, you highlighted a warning from JP Morgan. I think it was dated January 19, 2026. They used the word overcrowded.
Yes, this is absolutely critical. They warned that the trade on strong Asian currencies has become overcrowded.
What does that mean in plain English for us?
Imagine a really crowded theater. Everyone has piled into the exact same trade betting that Asian currencies will go up because the dollar is weak. It's a popular bet.
So everyone's on the same side of the boat.
Exactly. And because everyone is doing it, if someone suddenly yells fire, and that could be a bad economic report, a new tariff tweet, anything, the rush for the exit will be chaotic.
Because if everyone tries to sell at once, the price just crashes.
It crashes. The doors just aren't big enough for everyone to leave at the same time. And Reuters also mentioned a similar risk, something called the carry trade.
That's a classic Wall Street term. Can you break that down for us?
Sure. The carry trade is basically when you borrow money in a place with low interest rates, like the US, to invest in a place with high interest rates. Right now, a lot of money is parked in these high-interest frontier markets, but this is what we call hot money.
It comes in fast, it leaves faster.
It comes in fast, but if the US dollar suddenly strengthens again, it leaves even faster.
So even though things look really good on the surface, KOSPI at 5,000, strong currencies, the foundation is actually a bit slippery because, like you said, everyone is standing on the same side of the boat.
That is the risk. The fundamentals look good, but the positioning is what's dangerous.
Okay, let's try to unpack all this for the listener. We've covered a lot of ground today. We have the KOSPI shattering 5,000, and that's driven by this incredible AI chip boom and these new government policy reforms.
Right. It's a mix of future tech dreams and fixing old corporate habits. a powerful combination.
But, as you pointed out, it's a very narrow rally. It's mostly just the big chip makers and auto companies.
Hmm.
And the regular and investors mostly missed out, and the actual economy is, well, struggling.
And at the same time, you've got Asian currencies that are strong because the dollar is weak, but the smart money is using that strength to cash out of stocks and move their profits somewhere else, like to Europe or into bonds.
So, for someone listening right now who is trying to make sense of all of this, what is the practical takeaway? If I'm looking at these headlines, what should I really be focusing on?
My advice is this: don't get fixated on just one number. Seeing KOSPI 5,000 or strong one is just one piece of a much bigger puzzle. You have to look at the package.
The package.
Yes, you have to look at the interest rates, the stock valuations, and the currency all together. Just because the stock market is up doesn't mean the economy is healthy. Just because the currency is strong doesn't mean you should go buy the stocks. You have to understand the flow. Is the money staying or is it just passing through?
That is great advice. It's about the flow, not just the snapshot in time.
And here's the final thought I really want to leave you with. We are betting everything on this AI infrastructure boom. Jensen Huang says we need trillions more. The market believes him. But the big question you have to ask is this: is this truly a super cycle that's going to last for 5 or 10 years?
Or is it a hype cycle?
Or are we just seeing the peak of the hype before reality starts to set in?
That is the trillion-dollar question. Because if that AI demand slows down even a little bit, those 5,000 points could look very different very, very quickly.
Exactly. History's full of sure things that turned out to be bubbles.
Well, that is all the time we have for today's deep dive. We hope this cleared up the mystery of the 5,000-point rally and the great currency paradox.
Thanks for listening.
Don't forget to subscribe and hit that like button. See you next time.